What's up, everyone? Marcus Warren here, Warren Wealth Management. So it's been a wild August for markets. Recession fears kicked off the worst sell-off since 2022 at the beginning of the month, and then markets staged a choppy recovery, even notching the strongest week of the year along the way. And that's not so surprising because it's common for a strong recovery to follow a sell-off. Now, it's one of the many boring reasons that I recommend not abandoning an investment strategy when markets start to get jittery. By the way, if you even feel tempted to leave your strategy, please reach out so we can talk. Now, I can't predict the future, but I can show you what has historically happened and offer some reassurance. So what could happen next for markets? So I expect more volatility ahead. Despite renewed recession fears, fresh data seems to have eased investors' anxiety and boosted hopes that a recession-free soft landing is still achievable. Now, that's good news for markets, but there are plenty of risk to watch. So let's take a closer look. All right, so what positive factors could move markets higher? So inflation continues to head downward, which is good news for consumers and supports the case for interest rates cuts earlier or later this year. Other economic data is also showing optimism. Retail sales jumped unexpectedly, suggesting that American consumers are doing better than expected. Since consumer spending accounts for about 70% of U.S. economic growth, it's a big indicator of economic health. So analysts currently expect the Federal Reserve to cut interest rates in September. Notes from the last Federal Open Market Committee meeting showed policymakers are close to cutting rates. So we're keeping our fingers crossed for a September rate cut. But what negative factors could trigger a market downturn? Well, the labor market. It's starting to show cracks. The unemployment rate ticked up in July to its highest level since October 2021, and job growth slowed more than expected. So you can see in the chart that job creation has been slowing down over the past 2 years. Now, that's not entirely surprising since the labor market has been recovering from pandemic disruptions. However, recently released annual revision of the job data showed that the economy added nearly 30% fewer jobs over the last 12 months than originally reported. So if the labor market weakens and Americans start to worry about their financial situation, it could erode consumer confidence and spending later in the year. And that's interesting because the past few weeks have shown us how easy it is for investors to lose their optimism in a sell-off and then quickly regain it again in a recovery. So while markets tend to reflect the economy in the medium and long term, the opposing emotions of, talk about it all the time, fear and greed, it tend to have a greater influence in the short term. So we're seeing a lot of reasons to be optimistic, but we're also watching some clouds on the horizon. Though it doesn't seem likely that a recession is here or even around the corner, we're monitoring the data closely and we will be in touch as needed. And we expect markets to remain volatile in the coming weeks, especially given the focus now on the economy, interest rates, and of course the election. So if you ever have any questions about the economy, markets, or how politics could impact your portfolio or your income, please reach out. My job is to answer questions and solve problems for you. So don't hesitate to reach out. Until next time.